Hey there, everyone. I'm Dr. Emily Roberts from Personal Finance for PhDs. And today I have joining me my brother, Sam Hogan. Sam, will you please introduce yourself a little further?
Yes, I'm Sam Hogan. I work with Movement Mortgage, and I've been helping PhDs for the last 4 years become homeowners.
Excellent. So, our subject for today is home ownership, mortgages specifically, since that's what Sam does. And we are talking to a really specific audience, which is people, graduate students or rising graduate students who have just learned that they won the National Science Foundation Graduate Research Fellowship. So, congratulations to you if that is the case and you're watching this video. We have some particular, scenarios around homeownership for you all. And so at this time of year, we're recording this in April 2023. At this time of year, it's a really critical time to be thinking about whether you want to purchase a home with your new award. So that's kind of the subject for today. So before we dive into the questions specific to the GRFP, Sam, do you want to share your contact information in case someone already knows that they want to get in touch with you about their specific mortgage question?
The best way to contact me is via cell phone or email. My cell phone's 540-478-5803, and my email is sam.hogan@movement.com. For licensing purposes, my NMLS number is 1491786.
You may have heard from other fellows, from your peers, from older graduate students or postdocs that you can't get a mortgage when you're on fellowship. You can't get a mortgage unless you have like W-2 income. But we have found that while people have certainly run into problems, it doesn't have to be that way. So that's kind of the area that Sam's been working. So Sam, can you give us a slight overview of like how you work with these types of clients who do not have traditional W-2 income, but rather have fellowship type income?
Yeah, so you have to understand that this is new to a lot of lenders, and a lot of lenders blanketly do not accept the income, mainly because it's contractual and has contingencies within these awards and stipends that you have to, remain a full-time student, have a certain GPA, et cetera, et cetera. So some lenders just don't like it at all. We've found a way to document it in a way that our underwriters agree, and we can approve the income, especially if we have a lot of continuance, good history, and we can just show that their income is likely to continue and they're an expert in their field. PhDs usually are. So yeah, we've been helping PhDs for about 4 years achieve home ownership, and it's not a perfect process. Like the mortgage approval process is not always perfect, but we have found best practices and systems to have a lot of success.
Excellent. Okay, I want to drill down to this specific scenario of a GRFP recipient for the 2023-2024 academic year. They're expecting to receive at minimum $37,000 of income. It could be more if their school gives a bonus or a supplement to that, but let's work with 37 as kind of like the standard. Okay, so I'm imagining that someone watching this video knows they're going to receive that amount of money and they are totally unsure if that is a high enough, salary to be able to purchase a home of some kind in their housing market. The housing market has been through so much recently. Interest rates are changing. We don't know what the landscape is. So how do they look at that number and understand how much home they could afford and whether or not that even exists in their market?
Okay, so if someone's making that range of 37K, they basically will qualify for 4 to 5 times their annual income, dependent on their debt and down payment, basically. So a good rule of thumb is 4 to 5 times your income with about at minimum 3% down, but 3 to 10% is kind of like where our clients usually land. Either that's from savings or it can be from a gift also. The other way to find out accurately what you would qualify for is take your gross monthly income, divide that in half. That number, so if we go with $3,000 for your monthly income, your new mortgage payment and your existing debts cannot exceed $1,500. So, and these, I want to say these are debts that report to your credit. So like a student loan, an auto loan, credit cards, things like your insurance, utilities, cell phone bill, those things won't report. So don't worry about those. But if you believe you can, find a property where the home payment is, $1,300, and then you have a couple credit cards and maybe a student loan or two on your credit, and you can stay under that $1,500, monthly total, that is another way to see if you'd qualify.
Hmm. Okay, so I would say take those, numbers and ranges that Sam just mentioned and start on Redfin, start on Zillow, and start searching around in your local area. And they have like mortgage estimators for each property that you'll look at there. And so you can see, okay, does the mortgage payment fit within the parameters that Sam just listed?
Yeah, and I do like Redfin more than Zillow, but the calculators, from my experience, the mortgage insurance amount is usually double or if not, 150% of what it actually is. And then also the HOA fees is something you have to be aware of. So if there's a $400 HOA fee and you're already at a $1,300 payment, that would require more money down. Instead of 3%, you might have to put 10% down to get under that 50% ratio. And
Okay,
then
so
the
that
other,
50% number would include something like the HOA fee.
yes.
Okay.
So the 50% includes the total mortgage payment, principal, interest, taxes, insurance, and any fees. And then you have to add in also the other things that are reported on your credit report. So that's why we have the range of about 4 to 5%. Obviously, if someone has like a large Mercedes-Benz payment for $600, I'm gonna have to tell you, you got to sell that car if you want to buy a home. Usually, the PhDs I work with are not in that scenario. We find them to be relatively debt-free, having good credit scores, and a little bit of money to make the purchase happen.
Yeah, let's talk more about that. So let's say we've gotten to the stage of someone has figured out that their housing market is like within a realm of possibility that they might be able to buy there. And certainly this is limited markets in the US. This is not everywhere unless you have maybe a spousal income or something that you're dealing with. But within your market, you figured out that you might be able to afford something. How can someone watching this video sort of evaluate whether or not they're a potential like good borrower, a good candidate for being able to get a mortgage? Like what are the elements that you as a lender would look at?
So the three things that qualify someone are going to be your FICO scores, the income and income continuance, and then your budget for your down payment and closing costs. Obviously, if you don't have money for a down payment, you're probably not buying a house. Now, you can receive gift funds from a family member if you have that availability, but you have to have something to work with. There are situations where you can have the seller pay your closing costs and you can get down payment assistance. It is available, but no PhD in my 4 years of working with them have ever used down payment assistance. And I'll tell you why. Usually with the down payment assistance, it's not the best interest rates. So you have this tug of war of what I can afford and what I, what I can afford and what is reality. So you're not going to get the best of both worlds. You're not going to get the lowest rate available and down payment assistance and seller credit. Sometimes the market's competitive and you can't even ask for seller credit. So the ability for you to purchase weighs on, I would say, most importantly, your credit scores, then your income, then your assets.
Okay, so let's say someone watching this video, they know what their credit score is. That's even a hurdle. But let's say they know what it is or they know what the range is. What's a good range or what's like a minimum score that you would be looking for?
Okay, so minimum score is 660. Um, we liked anything over 720 is basically perfect credit. Now your credit will basically, it's a sliding scale. As you run up a credit card, your FICO scores go down a little bit. As you pay it off, they go back up. Unfortunately, PhD students cannot go with FHA loans, which allow down to as low as 580. FHA does not recognize the income. You must go conventional with either Fannie Mae or Freddie Mac, and their requirements are 660 plus. This also plays into your credit scores play into your monthly payment because if you put 10% down, you'll have private mortgage insurance. If your scores are 660, that mortgage insurance might be $150, $200 a month, which is going to lower where you're going to lower your purchase price, which you qualify for. If your credit scores are 720, 740 plus, that private mortgage insurance might be $65 or $70 a month. So that's important too. We try to stick with the 4 to 5 times your annual income and, this 50% threshold that you have to stay under. But when you talk with a mortgage lender, they will be able to get your actual FICO scores, your actual mortgage insurance rates to give you realistic numbers of what you're going to be able to afford.
So if you are an NSF graduate research fellow and buying is like anywhere in the realm of possibility for you, the housing market is reasonable in your area, you have a decent credit score, you have access to some money, I would say just go ahead and get a quote from Sam, get a quote from other people too if you want to, but that'll more solidify what numbers you're really working with and what you can afford in terms of being able to start, searching for potential homes. So just if it's like a possibility and you're interested, just go ahead and get a quote, I would say. Last question here, Sam. And this is the reason why we are talking specifically to the NSF GRFP recipients. The timing. The timing of this matters. So they get 3 years of support from this fellowship. And 3 years is like this key number in the mortgage industry. Can you
Yes.
explain about continuance and about 3 years and about when someone who's receiving this fellowship ideally would be putting in offers on homes?
The exact underwriting guidelines for all employment is the likelihood of 3 years of continuance. So at the start of a NSF award will be your best and strongest income support, showing that you're at the start of the 3 years and it's going to continue. It's going to continue on. Now, when someone is 1 year or 2 years into it, obviously, if you have 2 years, it's better than having 1 year. But when things get down to less than 12 months of continuance, just opens up some more questions about what they'd be doing after the award finishes. And we do have success with short-term fellowships, but it does open up more resistance from underwriting. And we might have to support the file with letters of explanation about your career path. So you have this little bit of, I like to call it a tug of war of balancing your work history with 3 years of continuance in the future. So if someone has a history of receiving awards like this and they have 6 years of getting stipends and fellowships, then we might have a better chance of getting the likelihood for that income to continue.
So
But
the
not
tug of
everyone.
war here is if you're, let's say, towards the end of your PhD, you're in your first postdoc, you can show, you've been a PhD trainee for quite some time, you've gotten all these awards, but we are talking to people who are near the beginning of graduate school, at or near the beginning of graduate school. And so I think what you're saying is that because they have less of a track record, because they're earlier on in their career, they have less of a track record of demonstrating that they can continue to receive funding. Having that 3 years of continuance in the offer letter is like, oh, okay, this is easier to say, okay, look, it's 3 years going forward. We know this. And so that's why it's important to, if possible, it's going to be an easier road for you if you can get that home purchase done prior to the award starting rather than after, because that clock is ticking down once you wait until the award starts.
Correct. So your purchasing window before your award starts is going to have less income documentation, and we're going to be able to go off just that award being starting in August, let's say, and continuing for 3 years. That opens up less questions, less documentation. When someone is a year and a half or 2 years into their award, they might be in a 6-year program, but we have to show and document the likelihood that this level of income is going to continue. Sometimes, their award is at 37,000 for 3 years, but when they have a remaining 2 or 3 years at the university doesn't match the 37,000. Sometimes they want to bring that back to 34 or 32. And so we're aware of these things. I am especially. So we know how to prepare the documentation correctly, show them enough to get them approved. And if we can present it in a way that supports their mortgage application, then that's how we're going to go forward.
Speaking of that window of being able to purchase before the award is actually starting to be dispersed,
Mm-hmm.
how far in advance of that first disbursement or that first paycheck can you actually close on a property and use the income?
It's a 90-day limit. So this is for Freddie Mac loans, and within the 90 days of new pay starting, you can use that future pay. Just like a normal job offer. If you're leaving one employer, and you have a job offer that's starting in a couple months, we're going to use that future pay because we're thinking about the ability to repay for the next, 30 years. So I highly recommend it because that's also the spring and summer shopping window. So the spring market's going to have more properties available for sale, and it will give you basically, maybe not the pick of the litter, but you have a larger pool of opportunities and properties to buy.
Okay, so let's say someone's award starts September 1st. So 3 months before that, that means they have August, July, and June to potentially close on a home and use that offer letter that's going to start in September. So that's the 3 months. So that's kind of the kind of
Yep.
window that we're talking about. Well, Sam, thank you so much for answering these questions. Good luck to those of you watching as NSF GRFP recipients. I hope this video provided some clarity about, if you might be able to buy, if you're a good candidate for buying and so forth. Once again, please reach out to Sam if you have any questions about your particular situation. By the way, Sam, in addition to being my brother, is an advertiser with Personal Finance for PhDs. And Sam, will you please close us out with your contact information again?
Yes. My cell phone number is 540-478-5803. My email is sam.hogan, Hogan, @movement.com. Thank you for tuning in, and congratulations on receiving the NSF GRFP.
Yeah, it's awesome. It's a great boon to your finances during graduate school. And if homeownership can become part of your picture now, so much the better.